Welcome back. So, before the break I was discussing the treatment of interest and depreciation while calculating FCFF. This is the formula, these are the formula for calculating free cash flow to the firm from various sources, from EBDIT, from EBIT, from PAT and from CFO. So, talking about the effect of depreciation, let us come back to that for a second. Let us recall, if you look at this, the PAT has the tax has changed from 30 to 27. If an amount of 10 is depreciation debited to the profit and loss account, if a depreciation of 10 is debited to the profit and loss account, if the tax rate is 30%, then the tax amount has decreased from 30 to 27. In other words, this represents a notional cash inflow, you may call it, or at least in some sense it adds to the cash flow to the firm, and therefore this DT factor is the why we add back this DT factor is because it is the saving on account of taxation. Taxation is a cash outflow. So, if there is a reduction in that taxation, then naturally it adds to the cash resources of the company. So, that is one part. The second part is, as far as the amount of D into 1 minus T is concerned, the post tax effect of depreciation, because that is not a cash flow at all, we need to add that back when we calculate the cash flow or the cash available for distribution to the various interest groups in the company. So, that is the reason that we add dt plus d into 1 minus t, that is d to the profit after tax when we calculate FCFF. So, I have discussed this thing. Now, there is another point here, why the change in debt is not deducted in calculating free cash flows to the firm. Why the change in debt is not considered while calculating free cash to the cash flows to the firm? Please note, when we calculate the free cash flow to equity, then we make adjustment for amount of debt, for the change in debt during that particular year. If there is an increase in debt, it is added when we calculate the free cash flow to equity, and if there is a repayment or decrease in debt, we deduct it from the free cash flow to equity shareholders. Now, the important thing is, the same thing does not operate when we calculate the free cash flow to the firm. Why is that? Let us try to understand it. Suppose during a particular year the amount of debt increases, the company borrows a certain amount, then what would it use that amount for? Either it would use that amount for financing some assets of the company, in which case the increase in the debt would be equal to the increase in either fixed assets or net working capital, and as a result of which the net impact on the free cash flow to the firm would be 0. The amount of increase in debt or the increase in FCFE, FCFF, I am sorry, FCFF due to an increase in debt would be neutralized by the deployment of that increase in either the fixed assets or current assets of the company. So, we end up with a 0 situation where the increase in debt has no impact on the available free balance for the various stakeholders, that is the lenders, preferred and equity shareholders. Now, the other possibility is that the cash flow that you get or the cash flow that you generate by fresh debt is used for repaying either the old debt or the preferred shareholders, in which case also the free cash flow to the firm will not change, because whatever is added on by way of increase in resources would be deducted, because the amount is being used to simply change simply replace the existing resources of the company. Therefore, again there would be no change in the funds that are available for distribution to the interest groups of lenders, equity and preference shareholders. So, in either case what we find is that the change in debt does not contribute to free cash flow to the firm, although it does contribute to free cash flow to equity, because if there is raising of debt, then that debt becomes available, at least in theory, to the to distribution to the equity shareholders. So, at least in theory, although there may be legal restrictions on this point, legal restrictions on borrowing and then paying to equity shareholders, there would be legal restrictions, but in principle as far as the finance is concerned, this would operate to increase or to enhance the resources that are available for distribution to the equity shareholders. Therefore, we need to make an adjustment for debt for any increase in borrowings when we work out the FCFE, but we do not need to make any adjustment for the increase in borrowings when we work out the FCFF. Reason because whatever increase in borrowings is either going to be used for financing fixed or current assets, in which case there is no change to the FCFF, and or it is going to replace existing debt. In that case also it does not change the situation. Now, an important point here regarding projecting of capex. Again I emphasize, I reiterate the point of compatibility, the point of consistency. If you are considering an increase in capex which is used to upgrade the operations of the company, upgrade the machinery of the company, and thereby increase the production, then you also must necessarily consider the impact of that upgradation, that improvement, whatever that may be, of the upscaling of the operations of the company, or maybe introducing a new product line. Whatever it is, you must also consider the cash flows that are likely to be generated out of that upscaling, upgrading, or refurbishing, or the renovation, whatever the case may be. The important thing is, I repeat, to maintain consistency. If you consider a particular capital expenditure, you must also consider the benefits that are going to be derived from that capital expenditure in terms of increase in or incremental cash flows that are going to be, or free cash flows that are going to be generated by the utilization of that capital expenditure. This is fundamental. This is, again I repeat, this is most important principle when we talk about any kind of valuation. To repeat, if there is any increase in capital expenditure or even increase in working capital, if there is any increase in working capital, the impact thereof in terms of increase in sales must also be considered when we work out the free cash flow. So, now we talk about calculating free cash flow to equity. The formula are absolutely similar, except that the delta debt term comes into play, and we deduct. Now, please note here, please note two things here. Number one, we are assuming that the preference shareholding is 0 for the moment. We keep it simple, we assume that there is no preference shareholding. Number two, earlier when we worked out the free cash flow to the firm, what we did, what were the stakeholders? The stakeholders were the long term lenders and the equity shareholders, assuming preference shareholding to be 0. The long term lenders and the equity shareholders. It was that basket or that bucket that comprised on the basis of which we worked out the free cash flows. Now, the long term lenders have been ousted from that bucket, have been removed from the bucket. Therefore, when we work out the free cash flows, we need to oust or we need to deduct the stakes of the long term lenders. And what is the stake of the long term lenders? It is their interest. But when you debit interest, there is a tax shield that operates to your advantage, and therefore, the effect of the tax shield needs to be considered, and the net after tax cost of debt has to be deducted from the free cash flow to the firm to arrive at the surplus resources which are available to the bucket comprising only of equity shareholders. And of course, delta debt has to be considered, that is, if there is an increase in debt, then that debt also becomes available to the bucket of equity shareholders, and as a result of which it adds to the free cash flow to equity, as I explained just now. However, delta debt will not operate, will not come into play when we work out the free cash flow to the firm. So, this formula then becomes self explanatory. We will start with the free cash flow to the firm. We deduct therefrom the stakes of the lenders, and that is I into 1 minus T, and we add any fresh borrowings if there are any, and we deduct any repayments if there are any on account of the debt on the lenders. So, the net result is that the free cash flow to the equity becomes PAT plus depreciation minus capex minus delta NWC. What is delta NWC? It is the increase in working capital minus plus delta debt. Now, free cash flow with preferred stock. I kept the exposition simple just a few seconds back when I said that let us assume that free preferred stock is 0. What happens if there is preferred stock? If you use this PAT and then and preference dividend has not been deducted from here, then we need to deduct preference dividend from here. That is one adjustment that we need to make. If there is a preference dividend and this figure is before preference dividend, then we need to deduct preference dividend from here when we calculate the free cash flow to equity. The second thing is, when we work out the free cash flow to equity, we will also have to make adjustment for delta preference shares. In other words, if there is a repayment of preference shares, that will need to be deducted. You see, the treatment is absolutely parallel to the treatment of debt, except for the fact that on the debt you get an interest tax shield, on the interest however, you do not get an interest tax shield on the amount of preference dividend. Therefore, I repeat, if this PAT is before preference dividend, deduct preference dividend without any tax adjustment, deduct the absolute amount of preference dividend, PAT minus DP say. And the second thing is, you have to add another term, that is delta preferences, that represents the change in the preference capital due to any fresh issue of preference shares or a repayment of existing preference shares. So, this is important. And now, what happens to the free cash flow to the firm? Let us look at it. What happens to the free cash flow to the firm? Now, if we start from PAT, let us assume that we start from PAT. If the PAT has preference dividend in it, it is fine, we do not have to make any adjustment. But if the PAT does not have preference dividend in it, we need to add back preference dividend, just like interest has been added. We have added the term I into 1 minus T because interest was debited to the profit and loss account in arriving at PAT. If preference dividend is debited to the account and PAT is after preference dividend, we will have to add back preference dividend, and if the PAT is before preference dividend, then we have to make no adjustment here. Please note this important point. So, we treat preference stock just like debt, except that preference dividends are not tax deductible. That is the bottom line. We treat preferred stock just as debt, except that preference dividends are not tax deductible, and therefore, we do not get a tax shield on preference dividend. Any preferred dividends should be added back to the free cash flow to the firm, as I mentioned, if just as after tax interest charges are to the net income approach in generating a FCFF. This is provided the preference dividend has been deducted from the PAT. If the preference dividend have not been deducted from the PAT, then obviously you do not need to add them back. This approach assumes that net income is net income to common shareholders after preference dividend have been subtracted out. So, that is what I mentioned, that if the preference dividend has been deducted from PAT, then you have to add it back. If it has not been deducted, you have to do nothing while calculating free cash flow to the firm. And as far as free cash flow to the equity is concerned, you need to have PAT which is after preference dividend to start with, and you need to make no adjustment for preference dividend. If the PAT is before preference dividend, deduct preference dividend because that is not available to equity shareholders, and if the PAT is before preference after preference dividend, you do not have to make any adjustment. Of course, delta preference shares will come into play. And secondly, the WACC has also to be revised to account for the preference shareholding or the preference dividend. When you work out the weighted average cost of capital, naturally, and the impact of the presence of preference shares will have to be incorporated while working the weighted average cost of capital. Now, steps in free cash flow based valuation, let us quickly go through them. Number 1, forecast the appropriate free cash flow stream pattern. So, then nothing will come back to it later, and in fact, estimate a suitable discount rate for the firm's free cash flow. This should reflect the riskiness of the realization of the free cash flows. In fact, the numerator should be the expected free cash flows, and the denominator discount rate should reflect the riskiness in the realization of those expected cash flows. Calculate the present value of free cash flows for the explicit forecast period. Assume a terminal value. Because we have an infinite stream of cash flow, so we need to split it up into two parts, the explicit forecast period, and then at the end of that explicit forecast period, what is the value of the remaining infinite stream, and that can be worked out as in the case of dividends. We will come back to it. Step 5, add present value of terminal value to arrive at the firm's value. Value significant non-operating assets separately, and the value of the firm is the present value of cash flows during the explicit forecast period plus terminal value plus value of non-operating assets. So, these steps are pretty logical, pretty simple and pretty straightforward, at least on paper they seem to be so. Then we deduct from them, if we want to work out the equity, deduct from the value of the firm, we deduct the value of equity share, we deduct the market value of debt to arrive at the value of equity divided by the number of equity shares to get the intrinsic value per share, compare the intrinsic value with the prevailing market price and take appropriate decisions. Now, estimating terminal value, I mentioned that just a few minutes back. As in the case of dividend, the two standard procedures are either you impute a regular pattern of growth of cash flows at the end of the explicit forecast period, or you estimate a particular multiple, and on the basis of that multiple you work out the value of the firm at the end of the explicit forecast period. I repeat, number 1, you use the Gordon model, that is you assume a uniform growth rate of free cash flows at the end of the explicit forecast period, and then sum it as an infinite geometric progression to arrive at the value at say t equal to the explicit forecast period, and or you assume a particular multiple that like the PE ratio, you estimate a particular multiple like the PE ratio, forecast the earnings at the end of the forecast horizon, explicit forecast horizon, and then on that basis using the earnings and the PE ratio you work out the price or the value of the firm at the end of the explicit forecast period. These are the two commonly used approaches. Of course, instead of using the PE ratio you can use P to book value as well. This slide gives you the working of the free cash flow to equity and free cash flow to the firm on a usage basis. So far we have been focusing on the calculating of free cash flows to the firm and free cash flows to equity on the basis of sources. So, cash flow from operations and all other things deducting them from capex and so on. Here we are working out it from the other side of the balance sheet, that is from the uses side, and this formula are pretty much self-explanatory, and they arise simply because the balance sheet must tally, and on the equality of the assets and liabilities side we arrive at this formula by using the formula that we arrived at in the context of calculating free cash flow from sources side. Now we come to a new concept, adjusted present value. Now discount what does the enterprise DCF do? Enterprise DCF discounts the free cash flow to the firm with the weighted average capital. Now this approach works reasonably well when the company targets a constant debt to value ratio. This is the fundamental premise on which you see, because the important thing is that we usually assume a constant, although it is not mandatory, but we usually do that, is to assume a constant working some constant WACC, weighted average cost of capital, over the life of the firm, and on that basis we do not change the WACC from year to year. That is the normal practice. Now that implies that we are having a constant debt to value ratio, because if the debt to value ratio changes from year to year, naturally the weighted average cost of capital would change, not only because the weights are going to change, because possibly the riskiness of the debt and equity, the relative riskiness of debt and equity would also change, and as a result the weighted average cost of capital would change. So, the enterprise DCF method, which assumes a constant WACC, is good enough only when the company has a constant debt to equity structure, and the enterprise DCF method is used when the cash flows of the target, in the case of acquisitions, are perceived about as risky as that of the acquiring company, and therefore the target company will maintain a similar capital structure as that of the acquiring company. So that is why we can use the target debt equity ratio, which is usually the debt equity ratio of the acquiring company to value the acquired company. That is what the enterprise DCF dictates. However, when this assumption breaks down, or in situations where the weighted average cost of capital could change over the valuation period, we can use an alternative to the enterprise DCF, which is called the adjusted present value approach. The adjusted present value is a good alternative when the companies target an absolute amount of debt. So, what is adjusted present value? The adjusted present value unbundles all the components of the present value and analyzes each of them separately, whereas the enterprise discounted cash flow WACC bundles all the financing side effects into the discount rate. So, that is the difference. In the adjusted present value, we segregate all components of the valuation, that is as you shall see just now, that is the value of the free cash flows, value of the debt related costs, bankruptcy costs and so on, and then we arrive at a composite algebraic sum of all these values to arrive at the value of the firm. Now, this is important or this is useful, because each of these components that contribute to the value of the firm may have a separate riskiness level, and therefore may mandate the use of a different discount rate. Let me reiterate, in its generality, what the adjusted present value would do, it would split up the various components of the valuation. For example, even the free cash flow to the firm component, or the part relating to the free cash flow to the firm, we would split it up into the free cash flows to the firm as if it was totally equity financed. Then we would work out the benefits or costs of shifting or replacing equity by the desired amount of debt, and then we would also work out the implications of that debt in terms of bankruptcy costs, and even we can also account for flotation costs. If the raising of debt entails a certain amount of flotation costs, we can consider that. So, all these separate components can be valued separately using different discount rates. That is the underlying thing, that is the important thing. We may use different discount rates depending on the riskiness of each of these components, which go to the determination of the value of the firm as a whole. That is the advantage of adjusted present value. So, how does it work in practice? Let us see. This was a general definition that I alluded to just now, but how does it work in practice? Let us see. What we do is, first of all, we value the entity as if it was entirely equity financed. We ignore all costs and benefits arising from the introduction of debt into the capital structure. We simply use, or we simply presume that the firm is totally equity financed. We work out the cash flow on the basis that it is totally equity financed. We use the unlevered discount rate, unlevered cost of equity rather, and on that basis we work out what is called the base case value of the firm, BCV, base case value. I repeat, what is base case value of the firm? The base case value of the firm is the value of the firm on the presumption, on the hypothetical notional presumption that it is entirely equity financed. The numerator, that is the cash flows, must be worked out on the basis that there are no debt funding costs here, and the denominator should be the unlevered cost of equity, unlevered because we are working on the premise that the enterprise is totally equity financed, and therefore, we must use the unlevered cost of equity and work out what is called the base case NPV. From the base case NPV to the base case NPV rather, we make algebraic additions. Algebraic means with the sign. If there is a value addition, we add it. If there is a value subtraction or for decrease in value, we subtract it. When we introduce debt into the capital structure, what happens to the value of the firm? If it improves, if it increases on account of the interest tax shield and so on and such other things, we consider the present value of those benefits. Now, here lies the benefit of adjusted present value method. We can use an appropriate risk adjusted discount rate for the valuation of the debt related benefits that is compatible with the riskiness or otherwise in the realization of, for example, the interest tax shield. How likely you are to be able to realize the interest tax shield? You must understand one thing: the tax shields are going to be realizable, they are going to be adding value only if the company has enough profits or taxable profits to absorb those tax shields. If the company is in losses, the company may not be able to derive the benefit of those tax shields. So, in order that the company has avails the benefits of the tax shields, it must be able to generate sufficient amount of taxable profits to absorb those tax shields and thereby reduce its overall tax amount. If there are no profits, there are no taxes. So, there is no question of reduction in the taxes unless of course, you can carry forward that loss to future years. So, that is the important point here. In other words, when you are working out the impact of debt financing in terms of tax shields and so on, you need to use a discount rate which is appropriate to the probability, the riskiness or otherwise of the realizability of those tax shields, and the APV method allows you to do precisely that. And of course, if there are if you are having high amount of debt, there is a possibility of bankruptcy which may entail incurring of bankruptcy costs, you can assess that, evaluate that on a subjective basis and take take cognizance of this while calculating the value of the firm. So, what are the steps in adjusted present value? Number 1, calculate base case NPV, that is the present value of the free cash flows to the firm. To equity assumed that entirely they are equity finance, and then discount the cash flows so obtained at the unlevered cost of equity. How we work out the unlevered cost of equity? We can use the CAPM method for that. KU is the unlevered cost of equity is equal to RF plus beta A. What is the beta A? Beta A is the asset beta. In other words, it is the beta of the firm. We will talk about beta in a later section of this course when we talk about portfolio management, but for the moment beta A is a measure of risk, measure of the sensitivity of the firm to the market circumstances. In other words, it is an indication of how the firm reacts or how the share stock of the firm reacts in response to market value changes or market price changes and into the risk premium. So, this is the formula that is propounded by the CAPM of William Sharpe, and we can use this for working out KU, that is the unlevered cost of equity. Now, how to work out the beta of an unlisted company? You see, as I mentioned just now, beta is the indication or is indicative of the responsiveness of the stock of the company to the market environment or to the market stock. In other words, simply stated, it is a measure of market risk. How the stock of your company or your holding or your portfolio responds to changes in the market or stock market or the market indices or well diversified market indices. So, that is what is beta, that is roughly what is beta, stating simply beta is a measure of the market risk. So, how to measure beta? Because that immediately implies that if you are going to measure the beta of a stock, the stock should be listed on the exchange, but it is not necessary that the valuation exercise that is given to you may involve a listed company, it may well be an unlisted company, and therefore, you need to work out the unlevered beta of that unlisted company in order to work out the discount rate appropriate for the valuation of that unlisted company. How do we go about it? What we do is we identify a set of companies which are comparable to the company that we are going to value. Say 10, 50 or 100 companies which are of similar dimensions in terms of the product range, turnover, capital structure and so on, which are analogous to or which have a close similarity with the company that you are assigned the valuation exercise. So, on that basis you calculate, because these companies you take the set of these companies which are listed companies, not unlisted companies. So, using this set of companies which are listed companies, what you do is you use their stock prices, and on the basis of their stock prices you are able to work out the beta of these 10, 50 or 100 companies in your comparable set or comparable sample. You using the leverage from the balance sheets of each of these companies, you unlever the beta of each of these companies. The process, the formula would be the same as that is given here. Formula 1, you use the debt equity ratio of the various companies from their respective balance sheets, the latest debt equity ratios, and on that basis you work out the asset beta or the unlevered beta of these companies, of this sample of 10, 50 or 100 companies, as the case may be, whatever number of companies you find and you choose as the comparable set. So, now you have the unlevered betas of all these comparable companies. You take some kind of a good average of these companies, maybe a turnover weighted average or a market capitalization weighted average or even a simple average. You take some kind of an average of the unlevered betas of these companies. This would serve as the unlevered beta of the unlisted company that you are given the exercise of valuation. So, to calculate the base case NPV of this company, of your company that you are doing the valuation, what you do is you work out the free cash flows on the basis that the company is entirely equity financed, and then you discount this free cash flows using the unlevered beta that you have arrived at by the process that I have just enumerated. Then the next step is to calculate the tax shields. The tax shields calculation is not so difficult. You know the amount of interest that is debited to the profit and loss account of any year, you multiply it by the average tax rate, you get the amount of tax shield. And what is the amount of interest? It's the amount of debt into the interest rate. So, the tax shield for any year will be equal to the interest rate into amount of debt into the tax rate. This gives you the tax shield for a particular year. Now, I strongly emphasized for the calculation of the value of this tax shield, we can assume that this tax shield would be perpetually available to us and value this tax shield as a perpetuity. But the important thing here is using what discount rate. The discount rate that you are going to use is something which you have to be very sensitive about, very careful about, because the nuances that are involved in the working out of the discount rate at which to discount the tax shields are quite significant. You need to have some basic knowledge of the tax structure as well as the provisions of the law taxation legislation, and on that basis and also taking into account the business risk of the enterprise. As I emphasized a few minutes back, the realizability of the benefit of tax shields depends on the fact that there would be adequate taxable profits to absorb those tax shields. If a company is in loss and it is expected to be in loss for a substantial period of time, then the tax shields may not be beneficial or may not contribute to the value of the firm. They may lapse without being taken advantage of. For example, in India we can carry forward business losses up to 8 years. So, if a company does not recover this the benefit of this tax shields within the period of 8 years, then they get lost forever. So, the important thing I want to emphasize is that when you are working out the value of these tax shields, you must consider the riskiness in the realization of these tax shields. There are two common approaches, the two ends of the spectrum, you may say. Number one, you use the cost of debt for the purpose of discounting. That is one approach, and that is justified on the count that you will be able to realize tax shields. There are adequate profits, but whenever you pay interest or to the company, and if you are not in default in payment of interest, then the tax shields would be realized. In other words, the realization of tax shields or the risk of realization of tax shields is equivalent to the risk in non-defaulting on the debt. If the riskiness of default on the debt or otherwise is mirrored by the riskiness of the riskiness in the realization of tax shield. So, that is one approach. The other approach is that the realizability of tax shields mirrors the business risk of the company, in which you would use the beta of the company or the discount rate, that reflects the business risk of the company for calculating the for discounting the tax shield. So, these are two extremes which you can consider, but the adjusted present value method gives you the flexibility to choose any appropriate discount rate which you believe is representative of the risk in the realizability of these tax shields. Bankruptcy costs are also another part. If there is a high amount of debt in the company and there are chances of the company going bankrupt, a company falling on bad days, and the possibility of bankruptcy is genuine, is significant, then you have to account for, or you should take account for the bankruptcy costs, make a subjective estimate of bankruptcy costs and incorporate it into the adjusted present value computation. The next is the capital cash flows model, which I shall take up in the next lecture. Thank you.